Alright, so I want to make this video just hitting home two main concepts. So it's going to be primarily the day count, which I have taken on board from Stacey Burke, and also then just the concept of we want to be trading when price is eating back into a peak formation. So as I said, Stacey Burke explains the day count extremely well. However, I just added it to one of my rules. But yeah, let me just break it down. So the day count is very simple. It's literally nothing more or less than 3 days of rise or fall. So these don't need to be back to back. We can get variations of it, as we can see here with an inside bar day, but in terms of like this market is algorithmic, it follows cycles, and one of the most simplest and biggest tellers of where we're going is the day count. So we're looking here, we're in this consolidation period, so I think this was this FOMC, or anyways, we're inside, so we are waiting for price to break out. So we get on Friday, then we get a break of Thursday's low, so we've got day one down on the Friday. So Monday opens up, we get day two down, and then Tuesday is an inside bar day. So what I mean by that is it hasn't taken out, these are previous days highs and lows, by the way. So we don't take out the high or the low from Monday. So this is an inside bar day. So then on Wednesday, once we break Tuesday's low, this is our third day taking out the previous day's low. So day one took out Thursday's low, day two took out Friday's low, and then day three take out Tuesday's low. So 1, 2, 3 times we've taken out the previous day's low without taking out a previous day's high. Let's hit that home. If we take out a previous day's high in between here, then the day count is messed up. So it has to be an inside bar day, or it doesn't work for the day count. So then day one, day two, day three, this leads to day one rise. So the cycle goes from being a down cycle to an up cycle. So we've gone from days of drop, now we're looking for days of rise. So we're looking for price to take out previous day's highs. So Wednesday is day one rise because we take out Tuesday's high. Thursday then proceeds to trade above Wednesday's high, so that's day two rise. Friday then takes out Thursday's high, so Friday is day three rise. And I'll show you now why I've got this written here, is because I bought down here and then kept trying to sell the pumps once we've broken out of the previous boxes based off of my rules. However, now I've added, as I said, the day count. It was day three that was telling me to short it. However, we were inside, we had a peak formation inside both directions, so I should have been trading on the outside then. But yes, that's the day count simplified. I'll just quickly go over it in US 30 just to hit it home. So we're basically looking for 3-day setups. So where price has taken multiple days to generate order flow, which will then all be taken in a fast, easy, quick move. So it's basically the whole purpose of counting the days is so you know when to put size in the market. So for instance, there will be trades based off of your strategy whenever, but by adding the day count, you then know when the extremely significant days or trades are primed to occur, and then you can then get yourself ready and be sized in with enough size to capitalize on the significance of the move. So every day we go down, we increase the chances of a reversal. So if we've gone down 3 days in a row, the odds of reversing are literally, I don't know what to say. I was going to say astronomical, but they're huge. So Monday, day one. So Stacey Burke says Monday is always day one, even though Friday could be day one down. Always start again on Monday as well. So, for instance, this was day one. This is also day one. So this is day one down. This is just day one for the week. So they're both day one. So day one, day two, day three. Day one down, day two down, day three down. So they both work. I know it's a bit confusing, but mark your charts up and then just continue to draw them out and it will make sense. So, but again, it is just simple stuff. It's just taking out previous day's highs and lows. So Monday, day one, takes out Friday's low. Tuesday takes out Monday's low. Wednesday takes out Tuesday's low. 3 days in a row, we have taken out the previous day's low, put in a peak formation, and pulled back inside and proceeded to break structure. Where are we going? Back to the high of the week. So the high of the week would have been a target here. However, we can see we actually did go up to the New York session from Friday. And again, Stacey Burke, what does he say? Markets only do 3 things when we reach the extremes. They break out, pull back, continue, break out, pull back, reverse, or break out, pull back, and go into trading range. That last one, it could just be they just never break out. But, oh, my Mac is about to die. Anyways, carry on. So, just what we can see here, we've broken out of the range, pulled back inside, and then proceeded to break structure. So this is a breakout, pullback, reverse. So once we take out the high of the week, put in the peak formation, and proceed to break structure, our bias is now switched to the downside. So we're then looking for peak formations to take our trades from. So like I mentioned here, we want to be trading when price is eating into a peak formation. Once our bias had switched to this short side, because we'd gone up day 3, broken out of the previous week's high and broken structure to the downside, we're now looking for peak formations to take trades from. So we can see we have a peak formation here, so we can see it by the large swing behavior. And we want to be looking for peak formations that actually did some damage, so ones that actually broke structure. So here's our structural point. Whoa. So yeah, we're always looking for peak formations that, so this structural point here, and we had this structural point here. So now we're looking, okay, so what actually sponsored the moves to, there we go, oops, what sponsored the moves that broke those structural points? So we can see it was this peak formation here, and also what took out this low, it was this peak formation here. So again, you can refine these zones, just basically supply and demand zones, but you can see that price returns to them for the trade down. Price returns here, the pump into this area here. So we basically always just want to be looking for where is the peak formation that I should be trading in. And again, this is fractal, so it's going to be on every time frame. So you can see here, we don't want to be just trading the highest point. We want to be waiting for price to trade, put in the peak formation, and then trade back into it. That's where we get our highest probability set up, so we can really scale into it because the direction's already confirmed. So here you can see you could have bought the low here, go into significant profit, but then price comes the whole way back down, because you want to be trading when price is eating back into the peak formation. So London puts in a peak formation, it's not the high of the day. You want to be trading when price is eating back up into that peak formation created. Again here, so this was day 2 down, so our bias is short. So London puts in a peak formation and then goes down. You don't want to be selling yet, because you want to be selling inside this area here in this peak formation. Again then, here we want to be selling somewhere in the peak formation created, which, look where this is occurring. Inside this peak formation. Whoopsie daisy. Not too best with drawing on the old MT4. But yeah, we can see there was this peak formation here, this London's peak formation, that took out all of these structural points. So we want to be taking our trades when price returns back up into that peak formation. So we don't want to be shorting until price is returned back up into that peak formation, because that peak formation was the one that broke the structure.